Hello friends, today we are diving deep into TCS Q1 results. Revenue of 63,437 crore, 12,760 crore PAT, an extended interim dividend of 11 rupees per share. Did TCS beat or miss expectations? Let's unpack it, but before that, please subscribe my channel. Disclaimer: the information provided in this video is for educational and information purpose only. It does not constitute financial advice, investment advice, or a recommendation. TCS reported revenue of 63,437 crore for Q1 financial year 26, missing estimates of 64,636 crore by about 2%. Despite a 1.3% year-on-year rise, this shortfall signals weak underlying demand, as revenue actually fell 3.1% in constant currency and declined 1.6% sequentially. On the profit side, PAT came in at 12,760 crore, beating consensus by around 5%. A Q-on-Q rise of 4% highlights profit resilience amid headwinds. Margin drove the surprise. Operating margin improved to 24.5%, up 30 bps from Q4, while net margin rose to 20.1%. This margin expansion reflects disciplined cost control and pricing power despite softened revenue. Another positive step, TCS declared an 11 rupees per share interim dividend with July 16 record date and August 4 payout, reinforcing its commitment to each return. So here's the verdict. TCS underperformed on revenue but outperformed on profit, thanks to margin expansion. The dividend adds further confidence. It's a tale of operational efficiency, rescuing headline softness, signaling disciplined execution even in a muted growth environment. TCS recorded 1.3% year-on-year revenue growth, but the story beneath the headline tells a different tale. On a constant currency basis, revenue actually shrunk 3.1%, reflecting a sharp decline once forex gains are removed. Sequentially, revenue declined about 1.6% Q-on-Q. Yet analysts were bracing for a near-flat result in CC terms. So TCS underperformed even modest street expectations. The BSNL project ramped down, significantly reduced revenue, cutting growth by around 75 basis points. According to broker projections, macro-related caution in client spending, especially amid global and US tariff jitters, hit discrepancy IT budgets. Put simply, the reported 1.3% growth was driven entirely by currency tailwinds. The actual business volume weakened, with BSNL winding down and enterprise caution persisting. The underlying picture is subdued. This indicates TCS is riding on forex strength, not organic demand, underscoring the need to watch Q2 performance closely. TCS reported a 24.5% operating margin, up a solid 30 basis points sequentially, with net margin climbed to 20.1%, a year-on-year gain of 90 bps, indicative of robust cost control and pricing power. Why margin expanded? Cost saving from the winding down of BSNL ramp-up and delayed wage hikes, high margin contracts in AI-led digital cybersecurity and cloud, pricing discipline, maintaining premium service despite weak demand. What it means? Margin expansion amid soft revenue growth shows TCS is lean and agile, prioritizing efficiency. This is not a flash gain, it stems from deliberate execution on cost rationalization and strategic deal wins. TCS reported a total contract value of $9.4 billion in Q1 financial year 26, a solid performance, though down from $12.2 billion in the previous quarter, making a 23% sequential decline. Despite the drop, TCS exceeded street estimate, which predicted TVC to have hover around $8 to $9 billion. This shows that deal pipeline remained resilient in a challenging macro environment. Focus sectors include AI, cloud, cybersecurity, quantum computing, and SAP modernization. Core highlight margin service that signal the company is aligning with future enterprise priorities. Even as overall contract value dipped, the mix is increasingly skewing toward next-gen, future-ready technologies. TCS's strength in AI-led transformation projects remain a key growth pivot, ensuring the company is well positioned for long-term value creation. TCS delivered net cash from operation of 12,804 crore, which equates to 100.3% of its net profit. Strong indicator of cash flow quality and earnings sustainability. On the talent front, the company added 6,071 employees sequentially, taking its total headcount to 6,13,069 as of June 30, 2025. However, the attrition rate has risen modestly to 13.8%, nearing a 2-year high. Strong cash conversion, 100% of net profit, is a hallmark of disciplined operational and healthy working capital. The ongoing hiring spree, even amid higher attrition, shows that while TCS is expanding its talent base, it's also facing retention challenges. This suggests a more cautious, efficiency-driven talent strategy in a complex demand environment. Here's how TCS performed across verticals, CC terms year-on-year. BFSI growth was 1%, while energy, resource and utilization climbed 2.8%. In contrast, sectors like manufacturing fell 4% and both life science and healthcare and media and communication plunged 9.6% each. Geographically, North America dropped 2.7%, Continental Europe 3.1%, and India suffered a steep 21.7% decline, reflecting softness in the BSNL contract. Meanwhile, Asia Pacific grew 3.7%, Latin America 3.5%, and MEA led with 9.4% growth. Broad-based weakness prematured key verticals and core markets, signaling subdued demand across TCS major business areas. Only MEA and APEC shows pockets of resilience. This uneven performance highlights the urgent need for TCS to pivot into stable, high-growth markets and industries as global pressure persists. TCS Q1 FY26 results were weighted down by several external challenges, a sharp decline in BSNL-related revenue as the large telecom project winds down. US microeconomic tariffs and geopolitical tensions have dampened client confidence in discretionary IT spendings. Client investment are being deferred. The result, enterprise capital expenditure is being postponed, further impacting demand from large corporate clients. The continued global macroeconomic and geopolitical uncertainties caused a demand contraction. These aren't isolated issues. They are structural headwinds with BSNL ramp down, US policy risk, and cautious corporate budget. TCS is navigating a challenging revenue environment. Investors should watch for recovery signals in enterprise spend and tariff stability. Following the Q1 results, TCS share edged up 0.3 to 0.4%, reflecting a neutral to slightly positive investor response to the profit beat despite the revenue miss. Analyst sentiment skewed toward cautious optimism. Brokers such as Kotak, Incred, Nomura, Another projected flat to slightly lower margins, anticipating a modest Q-on-Q dip in revenue of 0.5 to 1% in CC terms, primarily due to BSNL ramp down. While some analysts maintain a hold stance, a few view TCS as a buy, citing resilient margins and strong cash flow as key supportive factors. Overall, the market largely shrugged off the revenue shortfall, recognizing the earnings strength and margin resilience. Analysts are now looking ahead to Q2, expecting clear signal on enterprise spending and macro trends. Would you like this crafted? So now let's talk about the risk associated with this. Constant currency revenue weakness across multiple vertical and geographies, highlighting notable demand softness. Ongoing business stepper continue to drain top-line growth, especially in India. Macroeconomic volatility, including US policy uncertainty and global enterprise capex delay, impacting discretionary IT spends. Opportunities, margin resilience, while operating at 24.5% and net margin at 20.1% demonstrate strong cost management. A strong TVC of $9.4 billion and continued momentum in AI-led transformational services ensure future growth potential. Robust cash flow, rupees 12,804 crore is greater than 100% of net profit, provide flexibility for reinvestment and shareholder returns. TCS faces pressure from structural demand issue and macroeconomic headwinds, yet the company counters these with operational efficiencies, strong contract wins, and rock-solid cash flows, offering both defense and amenities for growth. Investors should track how effectively TCS converts a strong TVC and resilient margin into sustained revenue once macro condition improves. So TCS delivered a profit beat and margin expansion, reflecting strong execution even as revenue softened. This underscores operational discipline and resilience. Caution on revenue. However, revenue underperformance, particularly in constant currency, signal weakness in volume and underlying demand, highlighted by the impact of BSNL stepper and macro pressure. In Q2, what to watch? Keep an eye on whether the BSNL ramp resumes, if enterprise capex normalize, and whether macroeconomic clarity, especially around US tariff, emerges. So for long-term investor, consider accumulating on dips as the business fundamentals are solid and cash flow remains strong. For short-term traders, focus on clarity in revenue recovery and micro trends before taking new position. So you will buy on weakness, hold tight, and wait for more data. Please hit like, share, and subscribe this channel. If you like this content, please bell for future earning insights and do follow my channel for more such videos. Thank you.